Entrepreneurship can be really hard, and when you're doing it by yourself, trying to navigate the terrain, it can almost be impossible. That's why we created the Entrepreneur Circle. Every episode, you're going to hear from incredible entrepreneurs who are in the same trenches that you are in. And we're going to talk through what's working, what's not working, whether it be in marketing, finance, or anything in between. We're here to talk business and figure out how each of us can rise together. So welcome to the circle. Let's dig in. Hello. Welcome to this episode of Entrepreneur Circle. I'm your host, Paresa Noble, and today's show is going to be good, you guys. I am here today with the one and only Justin Maxwell. He is a partner in Big Life Financial. They have saved entrepreneurs $100 million in taxes, you guys. So if there is somebody here who could guide us on wealth building strategies, how to be smart and how we're spending in our businesses, it is you, Justin. So thank you for coming on the show. I appreciate it.
Yeah, thank you. I'm extraordinarily excited to be here. And I think that it's going to be, as we're listening to this, you're going to hear things that it's going to shift your perspective, and hopefully it changes your actions so that you create the life that you want to create.
Oh, I love it. So you used to be a teacher.
Yes.
We were chatting a little bit before we started. You used to be a teacher, and now you've gone into this game. I would love to hear kind of that transition. Take me back to when you decided you're done with teaching, deciding on what you're doing next. What was that like for you?
Yeah. So my life was centered on W-2 working in a W-2 job. And I was always playing it safe, and teaching to me was the safe destination for where I wanted to arrive. But I always had this internal desire that I need to play bigger and push into just astronomical goals. But I was afraid that I would be rejected. And so I chose the safe path, which was teaching. So my aspiration inside teaching was college. I wanted to be a college professor because that's like shooting big and working at universities. When I was doing my master's degree, I discovered that I hated doing research. I love reading research. I'm obsessed with data and stats, but doing research was not my cup of tea. And for the first time in my life, I had this earthquake of I don't know what I want to do, because I was on this trajectory of college teaching. I was teaching at a school at the time when I was doing a master's degree, but I knew I didn't want to be in a school teaching. So for the first time, I was rocked to my core a little bit. And I happened to go, I was invited to an event by a friend, and someone by the name of Garrett Gunnarsson was speaking. And the only way I can describe it is like a spiritual awakening inside of me of, I have control over my outcomes. I can build whatever I want to build, and I can create value in this world without relying on a job to do so. And that's what propelled me. I didn't know where I was going from that point, but it propelled me into where I am today. And it took 4 years from that event happening before I actually stopped teaching. But that was the propellant moment to get out of teaching.
Right. And it seems like you made the right choice.
Yeah.
Because not only did it completely revolutionize your own life, but you have revolutionized businesses. You've saved people so much money. You've guided them on how to structure, what to do to thrive, right? That's why we're all here, is to maximize our profit and thus our impact. And I think there's a lot of things that as small businesses, you can get clouded in what to do to get there, right? There's so many people giving advice. There's so many different avenues you could take. Speaking to this audience specifically, when you're looking at a small business that's really just starting to see that momentum, they're starting to scale, what are the pitfalls that you see businesses make that you could kind of deter the small businesses from doing?
I think there's two that come to mind. So the first is usually where they're now starting to see success. That usually was their goal. $1 million in America is thrown out as this is where I should get to. So as people start getting closer to that, that's their end destination, but they don't have what comes next. So you need to be really clear around where you're actually going with your business, with your personal wealth, and what is the destination you want to. Otherwise, you're just going to be on a treadmill that you never know where your actual arrival point is. So you probably have gotten to where you wanted to go, but now reset it and clearly define the next step so that you know the direction you're going next. I've seen too many people that just stay, they don't know where they're at, so they just stay where they are, and they're just in a circle. So that's the first one. The second one is Once you know where you're going, you now can start asking the question of, if I do this today, we'll say this investment opportunity that's being proposed to me by a financial advisor or this tax strategy, if I do that today, is that going to help me get to my destination in the time frame that I want to? And if the answer is no, we now know that I don't have to do that anymore. And I can say no to that person. And it starts to empower the business owner to take control of their own, because they know where they're going. But so many people don't know where they're actually going or what's possible, that they can't filter those things. So you're correct. It's a flood of information. There's thousands of financial advisors, thousands of accountants, thousands of insurance agents that are constantly pitching you, because you now are the ideal client for every person in the industry. That can be a filter in of itself to determine are these things good or not.
It's that clarity. I feel like that's the key. There's this analogy of, if a plane were taking off from, say, Denver, and they were headed to New York, if the nose of the plane is off even just 3 degrees, by the time they get to that side of the country, they're going to be in Delaware, because it's that, over time, you just get farther and farther from the target if you're not crystal clear on where you're going.
And the thing I love about that analogy is it feels like you're making progress because you're flying. You're actually going a direction. So you're like, everything's good, but then you land in the spot where you didn't want to land because you weren't clear on actually where you wanted to land fully.
Right.
So I love that analogy too.
Oh, yeah. I mean, it's helped me a lot. And I think I'm looking at even my business and the money decisions that I should be making, as far as like truly the tangible things. So say you have kind of like a base, right? You build up your profits for any case of emergency, right? You have that base layer. Then beyond that, I mean, do you suggest businesses go invest, or is it wiser to kind of, make taxes and tax strategy be kind of the return that you would get?
Yeah, I really like that question. And so again, I'm going to point back to, what is our destination? So always keep that as our North Star. But the next thing I want really to focus on is view the business not as a business, view it as an asset. Too many business owners think that wealth is built by where they put their money, but it's actually built through the business they're creating. But too many businesses are built to be income sources, not assets. Income sources are not valuable to be sold someday. Assets are valuable to be sold. So you need to change your perspective on how you view your business, and view it either as a cash flow machine or an actual asset that will spit off cash flow, but eventually be sold someday. That perspective will take you to higher levels of wealth than choosing to, because everyone wants to say, well, we got to stick in the S&P 500 and invest outside of my business. And we can talk about that and like where we would recommend doing that. But your highest wealth potential is in your business. You own it. You have the control over it. And the amazing thing is if you're approaching that $1 million mark or at the $1 million mark, you've done something that the vast majority of businesses have ever done. Now you just need to shift it to, this isn't just my business, this is my asset.
Okay, let's dig into this. Because when we talk about exit strategy and building to sell one day, if that's something that you're deciding to do, what are the things that can build the asset? Like, are you seeing specific, actions, whether it's like, okay, let's get a bunch of patents, or what are the things that you're seeing that would increase the valuation of a small business?
Yeah. So I love this topic, because I know that private equity has like a terrible industry. Like when you say private equity, usually it's like an icky feeling. Like people are like, oh, that's kind of icky. I don't want to be a part of that. But there's a reason that they've been, for the last 200 plus years, the most successful asset class, because they understand value. They don't view businesses as businesses. They view them as assets. So they're looking at the numbers. But there's two things that I want to put in people's minds. So most people think that value is created through EBITDA. So everyone drives their focus on, how can I be more profitable? Baseline, that's the baseline valuation. But just because you have a profitable business doesn't mean it's an attractive business. Doesn't mean someone's going to buy it from you. Oftentimes what happens is, because everyone focuses on EBITDA, when people go to buy it, they're like, well, you're the EBITDA, not your team. Like the business is not the EBITDA, you are the EBITDA. So if you disappear, I don't know how far it's going to drop. So we have to stop. We have to take ourselves out of the identity of the business and make it the business its own self. It has nothing to do with you.
Mm-hmm.
So there's 4 capitals that bring value to a business. It's human capital, which is the strength of your team. So without you being there. So can your team run the business without you? If you can prove that, your valuation on top of your EBITDA will now rise. You're more attractive to purchase than someone that doesn't have that.
Mm-hmm.
Social capital, which is in your community or in your sphere, what do people say about you? Are they talking positively about you? Are you sponsoring things and your name's out there in the community and even non-customers start to recognize you? Can you prove that? Structural capital, like what are your systems? Are they documented? Is there a step-by-step checklist of everything that happens in your business? If you have those things, you're more valuable than someone that doesn't. And then the last one is customer capital. How easy is it for you to get testimonials from your customer? Do you have a lot of raving fans? Do you have recurring revenue? All those things I just said are not found on a P&L, but that's what people buy. Because your buyer, whether you think it or not, they're subconsciously an investor.
Right.
Even if it's like we work with a lot of dentists, like dentists can sell their practice to another dentist. Someone's going to buy it from them, but they're going to offer a higher price if they know that there's going to be less attrition. If they know the business runs without the other dentist being there, they'll pay higher amounts of value. That's an investor decision. That's not a business owner decision. They're unconsciously thinking that because they know that they're getting a loan for X amount of dollars and they're going to be able to pay it off in X amount of years. So that's ROI. Like that's what it is. And that's people buy, investors buy businesses, even if it's just someone doesn't even identify as an investor. So the more attractive you make it to investors, the more money you'll get.
It would just increase the multiplier.
Correct.
I mean, usually, at least in my industry, we're a podcasting agency.
Yeah.
So in our industry, it's kind of like a 2 to 3x multiplier just looking at EBITDA. But then you factor in these kind of unicorn elements that you just listed off. Could that take it up to like a 5x multiplier, 10x multiplier?
Yeah,
Have you seen that before?
It could. 10 is probably a little extreme for that, but there's other things we can do though to make it 10.
Oh, interesting.
But think of it like, I like to compare it to real estate. Like if everyone's lived in a neighborhood where 2 houses went on the market at the same time. They're the exact same house, but one went in an instant and one just sat there and sat there and sat there. The one that went quickly is because it was so attractive that everyone wanted it really quick. Like they redid the bathrooms, they made it nice, they put nice smelling cookies and like did all the stuff to make it attractive. But then the one that sat there probably needed a little bit of rehab, probably needed a lot more work. You had to put money into it on the back end. That's what's happening in a business. So the more you can make it attractive to a buyer and just make it look as sexy as possible, the higher the likelihood that someone will buy it from you.
Wow, that's gold.
Now to get to your, how do we do this better? So again, we're going to use private equity as the example. Private equity will buy EBITDA to attach it to them, and then they'll take their strong, attractive businesses, systems, and structure, and they'll imprint it on the new business. And now you have 2 companies. So the way we like to view this is private equity will have a platform company. That's like their base. That's where the management is. That's where the CRM is. That's where all the sexiness of the 4 intangible capitals lies. That's their takeoff point. If you, a small business owner, can make your business the platform company and you already have the systems dialed in, you can acquire businesses just like they can, because there's plenty of competitors. There's plenty of people right at your size. You add their EBITDA to yours. And if you can get to the $10 million EBITDA mark, you will have a 10x multiplier. It doesn't matter your industry. Private equity firms will pay you that amount of money. And the other fact is that you have the intangible capitals to go with it. So now you're super attractive and you have the EBITDA to back it up. But so many business owners are focused on organic growth and just growing over time. I'm going to grow at 10% a year. And how do I acquire more customers to get better digital marketing? All that's really important. But if you then shifted to, why don't we do that with me out here looking at how to increase the value and make my business more attractive? So when I get to the end, I'm selling for just ungodly numbers.
Yeah.
I can share an example. So we had a client, $1 million of EBITDA, had a $3 million valuation. He chose not to sell. He chose to buy another $1 million EBITDA business. After a year, they had the combined EBITDA between them was $3 million. They then at that point bought another business that was about a $3.5 million EBITDA business. After another year, they were about $7 million. And then at the end of year 3, they were in the $8 million range. They sold for $100 million. after all, because there was debt you have to go into debt and leverage yourself to pull this off. He walks away with 44 million instead of 3 million.
Whoa.
He more than 10x'd his valuation in 3 years, but it was because he viewed it as an asset, not just a business. You can't just do this if you don't choose to make your business attractive and choose to think of it like, would someone buy this from me? Mm-hmm. If you choose to ignore that, you can't go and acquire, because you're adding a lot of problems to a situation where you're merging problems with something else. So it doesn't work. So you have to shift from I'm just a business owner to I'm an investor.
Right. Okay. So from what I understand of your work, you are also helping people with their personal, investments as well. I remember listening to you on one of the forums calls, and you're talking about, you or your team were talking about, most financial advisors are investing in the stock equity game, right? Equity bonds, right? Stocks, bonds.
Correct.
Yeah, that's the divvy up. But you guys are looking at, that's a piece of the puzzle, but then there's real estate, private equity. There's, just kind of building it like an endowment fund, I believe is how you guys phrase it.
Yep.
So when you look at all the different types of investments that we could make, what do you think? Maybe you could speak a little bit to how structuring our investments plays into our overall wealth capacity.
Yeah, I really, really like this. This will pair off well we just came from. So the first thing I want to make sure that is really clear is I'm going to be talking about specific investments. This is not investment advice, and you need to talk with a professional. This is just for educational purposes only. But the first step you have to get right in all of this is we need to commit to saving more money. So it's not sporadically saving or saving what's left over. We create a deliberate saving system. And the closer you can get to 20%, the faster the wealth outside your business will grow. So 20% of or above will be able to replicate your income in the future. 20% or below, you're playing it by how does the portfolio perform. So create a system that eventually gets you to 20%. It doesn't have to be 20% today, but it can be 20% in the future. And this is where we then pair in the tax planning. So we want to save taxes so that we can save more money into the system that then gives us the permission to either invest into other people's assets or into our own asset. But we have to create the system first. So create an automated system that gets you as close to 20% of your income as possible or above. That's step one. Once you have fuel to then invest, the strategy that we employ is what's called the endowment model, which is what you articulated earlier. I'll just explain. I'll do my best to quickly explain that. If I'm not doing this well, please stop me and say I don't understand what you said.
Deal.
The reason it's called the endowment fund is because America's largest universities, they have endowment funds that pay scholarships and build buildings and pay professors to come and all of those things. The way that they invest their portfolios today is dramatically different than the way they invested them 40 years ago. So in the 1980s, they had what looks like the exact same portfolios that if you went to a financial advisor at Edward Jones or Charles Schwab or Merrill Lynch, it looks a lot like that, where it's the 60% stocks and it's large cap REITs, small cap tech, and diversified inside of that, and then bonds on the other side. That's what it looks like. Mm-hmm. But the endowment funds no longer do that. That was 40 years ago. They have shifted dramatically to what has now been coined the endowment fund. And it's not just diversification within the public markets, it's diversification within asset classes. So they own private market investment opportunities. They own private companies. So they actually own physical real estate. It's not in a REIT. You couldn't get it on the public. There's no ticker symbol. They own buildings. They own houses. They own multifamily. They own private equity companies. They own hedge funds. They own commodities. They own private. They do private debt and private lending. They invest with family offices, and it's the reason they do that is they want to have not equal splits between them, because usually they have a strength that they have more of, but they want it to be that if one of those asset classes has a fall, it doesn't affect the entire portfolio as a whole. And is what has happened with this is there's something called standard deviation, which is what's the typical difference between peak up and the fall that happens after. The S&P 500 has about a 15% standard deviation. the endowment model reduces that to about 5. So they don't fall as far, but they also don't go up as high. But Yale is this is just one example. Yale, everyone produces their numbers, but Yale is like the top performer. Over the last 20 years, they've done about 13.1% inside of their portfolio, which is the endowment model style. And the S&P 500 has done about 9. So, but it's not even, that difference is not even what we should be looking at entirely, because that difference doesn't take in the fact the volatility either. Volatility costs people money. People don't think it does, but it actually, you lose money when you fall. Like you actually have lost money. Now there's new cash injection, which gets you back up faster, but you have lost money. So the more volatility you have, the more you have to dig out of the hole before you're back to break even, and then you're back to profitability again. So if you have less of that, it makes it so that the spread between 13.1 and 9 is bigger than 13.1 and 9 if the standard deviation was the same. So that's the way. Now that's people are like, okay, I get it, but Yale has billions of dollars and I'm just a normal everyday business owner in America. How could I get access to that type of investing? So that this is the hard part on this, is that you're not going to get that from like a Merrill Lynch person or an Edward Jones. Like that's just not going to happen. So you either have to choose to say, I'm an investor. I'm not a business owner. I'm an investor, and I'm going to go learn how to get into these things, or I'm going to leverage in a firm that does. And there's not a lot, but there are firms that can give you access to those portfolios. And now you can start to shape it yourself so that you have the same type of asset classes, but without the risk. Because the biggest risk in the private market space is that you lose all your money and it's all gone because you didn't know what you were doing and you got caught up and you just invested with some random company and then they went belly up. That's a risk in any investment, but it happens more in the private market.
Does your team do that?
We do that.
Oh,
yeah.
That's beautiful.
Yeah.
Okay, we'll have to put your information in the show notes so you guys can reach out if that's appealing to you. So I that is so valuable. I appreciate you kind of giving that nugget. I'd love to switch gears and talk about your business, because you guys have obviously, we're recording right now from 4 Rooms Mastermind, and this is a room of really high level entrepreneurs, super successful. They've hit the numbers, and you're the leader of the leaders, if you will, right? I think there's a lot here that everybody's learning from you. And I'm curious, from teacher to where you're at now, for you specifically, what did you do to grow your business? Where did that momentum shift happen for you?
Yeah, that's a really profound question. I think for me, it's in understanding the power of leveraging a team. So many business owners want to do everything themselves, and they are unwilling to trust or delegate other people to handle things. And usually it boils down to there's a lack of leadership skills in how to actually get people to do what you want based off of the delegation task. So then they don't do it right, so you get frustrated, and then you have to feel like you have to do everything again. But learning how to lead enabled us to grow Big Life Financial. But then this is the piece that most business owners miss, is they'll get that right. They'll lead their business beautifully, and then they'll let their personal finances not be led beautifully. And they make all this money, and then all the wealth just falls through the cracks, and they actually don't receive any. So you have to lead your business and lead your personal wealth in the exact same manner. And when you connect those two, that's when really possibility of like what's possible in the future starts to be unlocked.
Yeah. Finding that synergy between the two.
Yeah.
They're not two siloed pieces. They're all one whole
same
encompassing part of you. Yeah.
Correct.
That's a big piece of it.
Yeah.
I remember on our drive here, you started talking about the fact that you want to start speaking more, getting in front of more rooms, helping people with these exact things in their business, giving guidance. And that's been, a successful way to get your message out there, but also to just almost like a business development strategy, right? Is that something that you are wanting to pursue more of? Tell me more of why that is something on your heart.
Yeah. So this is going to touch into like my personal vision of like what I'm creating as a family. So I need to set some context here. most financial people have you aim for an end date. They're putting an end on your wealth creation ability. So 65, 60, and some people are like, I want to retire early, but that's ending your wealth creation ability. I want to shift that from don't put an end on it, just put it infinitely out there. So I have a vision that in 20 years, my family will give away $1 million the first time. And it will be not the first time, it'll be the first time into the future perpetually. So I'm going to have a perpetual giving system that will continually getting bigger and bigger, and $1 million a year from 20 years forward. So 2045 into the future. 150 years from now, I want that. So I'm going to be gone in 150 years, most likely. $1 billion is what I want it to be giving away. So I'm creating something that's going to perpetuate beyond myself. But the only way I can create that within my family, which is my primary driver to create a perpetual giving system, is for me to be able to create systems on how to do that. And the only way I can do that is if I speak and talk about it and think through things. So my primary driver for why I want to do it is it will grow my business, but it's actually because I want to imprint that message into my family so that my children have it, my grandchildren have it, my great-grandchildren have it, so that they're on board with that mission and giving them the frameworks and tools to make it happen.
Yeah. Oh my gosh, that is so powerful. That is so powerful. I think that just illuminates why we're even here in the first place is money. It's not all about making money, making the profits, getting the nice things, right? It's what can we do with that? I mean, the impact that would come from perpetually giving $1 million to where is there a specific
No, so that's the amazing
cause?
thing is
Okay.
that it's going to shift because I can't control what my family is going to care about in the future. But the structure of there's a tool called private family foundations. Most people think it's reserved for billionaires. They use it more often than not, but it's reserved for people that still like even your audience, the $1 million business owner might consider a private family foundation. It won't have $1 billion in it, but it can still give $10,000 a year away to start off, and eventually it gets bigger and bigger. But that gives the family the choice to what do we actually care about and what is the impact we want to make. And so that does twofold things. It brings the family together to have discussions around not what are we going to spend money on or what are we going to do, who are we going to help and why are we going to help them and what are our proposals and who are we going to go do it with. So it could change from year to year. There'll probably be years where it will be the same over and over again, but it gives the family the autonomy to do it on their own.
I love that. I am inspired by that because it's not just you that's doing that. You're bringing your family in on this mission that is going to be multi-generational. You know, if they're bought in, they're going to pass it to their kids. And it's something beyond just building your own, you know, or I'm going to invent this product and we're going to let this one ride for years and years. It's giving, it's making the community better. Good on you, Justin.
The reason I'm so passionate about this is because there's so many successful, like your audience is already super successful. They're making more money than 99% of the world, like 99.5% of the world. And they often don't see it, but they're usually the only ones in their family. So it's like this boom person that shoots upward. But then you look at the data around like how generational wealth happens. One generation or two generations, it's all back down to here. So you have all this boom and bust. There's no progress being made, or the progress is much slower. And when you start thinking this way, it's I want to boom upward and I want my family to take off from here and they're going to take up to here. And then it's just going to keep perpetually going forward. Like I envision my family being seen as world changers in the future because they're thinking abundantly, they have the capital to do it, and they're giving away a whole bunch of money at the same time. But I want to give them that vision so they can actually capture it and make it real. And so speaking gives me the ability to articulate that to other people and start to refine how can I create frameworks and actual systems that will give that the highest probability of success.
Right. Oh, and I love that. When you get on stage, you're not only impacting the people that are in that room, but it's almost that legacy play. Those are going to be recorded. They can be shared. I see the vision. I love that for you. Congrats, Justin, on what you've built. You guys can probably tell there's levels here, right? I'm very grateful that you joined me on this show, Justin. How can people connect with you? How can they plug in?
Yeah, the easiest way is I'm pretty active on social medias, but LinkedIn is probably the easiest one. So just search Justin D. Maxwell on LinkedIn. I also have a YouTube channel. It's not fabulous, but I do produce things there. Again, Justin D. Maxwell, you can find me there. But just Googling my name, you'll find my speaking website. You'll find our Big Life Financial website, and you can connect there's places to connect and get on my calendar and things like that.
Perfect. I appreciate it, Justin. Thank you for coming on the show.
Thank you.
And thank you guys for tuning in. Make sure to check us out on the next episode. We'll see you later. Remember this as you go about your day today. The ideas that are on your heart for a reason. Do not ignore them. Tune into them. Tap in, lean in, understand them, and pursue them. If not you, then who? If this episode was helpful to you in any way, please like, share, comment, subscribe. It does wonders for our efforts, and it helps us to continue our mission of inspiring entrepreneurs and giving them the resources and the perspective we all need to take it to the next level. Thanks for tuning in. I'm Paresa Noble, and we'll catch you next time.